Okay, good evening. Tonight is Tuesday, October 30th, and we just did quiz 3. So tonight I'm going to start chapter 21. 21 is like 16. It's quite a, there's quite a bit of math in it, and there's quite a bit of content. So, especially since it fell on a week with a quiz, I thought it wasn't really possible to cover 21 in it. Every time I've tried to cover 21 in a single lecture, I really, kind of pile it in at the end. So I split 21 into about 2 parts. So we'll do the first part of 21 tonight, and then we'll do the second part of 21 next Tuesday. In terms of announcements, last week to find a Go Help a Real Business project. If you haven't found one, we're in October. We're into November now. I've had people before. They do like really awful on the quizzes, and then a week before the end of the class, they're like, "Oh, I found this business." So I don't want to end up in this situation of having to say no when I didn't make a clear rule. So I'm making a clear rule that if and there's like 2 or 3 that people just gave me like today or yesterday that I didn't get around to calling today, but those are fine. But you need to get, not necessarily that I've been able to reach a business owner, but if you still by Friday haven't even found a business, then it's too late. Like, don't come to me like mid-November saying, "Oh, I'm going to work like 20 hours in one day." It's not going to happen. So tonight, chapter 21. So like you said, I split it about halfway. I'm going to talk about, I wouldn't say the really easy part, but really the first half, because the kind of the toughest part, one of the toughest questions to understand is at 21.4. So, but then after that, for next week, this is where 21.5 is where really the toughest part is. It's about doing capital budgeting like we've done in chapter 9, 10, 11, but when you toss in currencies and it gets a little bit more complicated. And then the rest is qualitative stuff for, okay, why do we care? What are the issues in finance about dealing with international type of management problems? The main one is when you have a business that operates in more than one currency, and there's quite a bit of challenges there. Because, for example, if you do say a budget and you plan on making say that much money over a certain period of time, and you have to pay say some of your cost in a different currency, well, a project can go from very profitable to very unprofitable quickly if the relationship between the currencies change. So we're going to look at how do you handle some of these things, and also political risk. There's not really much math there, but I'm going to talk about it towards the end of next week. And the international capital markets, that one of the reasons why currencies move is when people from one country want to invest into another country. So that's one of the reasons. Well, that together with the fact that in Canada we have lots of oil, those two things have been, a lot of people are nervous about the US or other countries. They see Canada as a fairly stable area, so they want to invest, so that's money coming in. And also, there's oil coming out, so either somebody has to pay us in our money, or we get paid in a foreign money, and then we have to transfer it back to our own money. So, in terms of financing, though, it does open up other markets. For example, Canada, I don't know if they still do that, but they used to issue bonds in US dollars or issue bonds. I think at some point even they issued bonds in yen and so on. So, but I'm going to talk about it in more detail. Now, some of the vocabulary that's in the textbook, Cross rate is, picture makes more sense. If, say you have a Canadian dollar, and you want to know, say, what is the exchange rate to the US dollar? There's not a lot of, that's not a very big market. There's not a lot of people that, say, land in Ottawa and want to exchange Australian dollars. So what happens? You have a middle currency. So this would be, direct rates. And so what the cross rate is, it's the rate that's implied you look at the exchange rate between the Canadian dollar and the US dollar, and the exchange rate between the US dollar and the Australian dollar, and that gives you a rate to transfer Canadian dollars to Australian dollars. Here's the reason. Think of, there's, say, 10 more or less big currencies in the world. Well, and then there's, say, 10, so you want to look at what are all the different possible exchange rate. You're talking about 100 different possible exchange rate that somebody would have to quote. Now, instead, if you just quote each one, say, relative to the to maybe the US dollar and the euro, then you're able to, as a foreign exchange desk or a dealer, quote a price by only looking at, what would that be? Say you had 10, 20 instead of 100. So having that concept of this cross rate is used to minimize the amount of different rates you have to quote and track. The next two, I'm not going to ask you that in a final exam or a quiz because they're in the textbook, but they're a little bit outdated. In fact, it's one of those things that they're so old that the word is coming back into existence, but that's more now. It has a different meaning. Euro currency used to mean a deposit into a foreign bank. So here's an example. If I have I have a business in Germany, but I have a US dollar account with, say, Deutsche Bank, then, or that would have been called back, we're talking 80s and 90s, that was called a euro dollar account because it referred to where that dollar was. Now, euro currency nowadays actually exists, so the term is not really used that same way. Now it's more, foreign. Plus, banks are so global anyway that you don't see that expression. And Eurobond was in a similar context. It's when one country or perhaps one corporation would issue their bond in a different currency than their domestic market. So say if Canada want to sell their bonds into the Japanese market, and they denominate bonds of the Canadian government, but that paid principal and interest, say, in Japanese yen, that would have been called a euro bond. Obviously, the reason why that was is because a lot of, the U.S. would sell bonds into Europe, and then European countries would mostly denominate their bonds into U.S. dollars. So that's where the expression came from, but it's not really in that common use anymore. Export Development Canada is a crown corporation that helps Canadian companies when you want to, especially when you have large transactions. Say you're, you're manufacturing like mining equipment, and like one piece of mining equipment costs like $250,000. Well, there's a lot of challenges with shipping the thing over, who gets the money, and how does it get transferred. Basically, Export Development Canada acts like a bank in that it will finance accounts receivable when you're exporting stuff to other countries, and over time they've grown to be the kind of single point of contact that if you're a Canadian company and you're trying to do business, mostly because governments are always trying to boost up their exports. That's a company, that's a bank or a government organization that has quite a different, quite a few useful programs for Canadian companies that are trying to do business with in other countries. Now, gilts, those are kind of a nickname of British bonds. There's some other can't remember the other ones, but LIBOR's been in the news lately, and it's the most important interest rate in the world because historically banking was started in London before it started in New York, and so London has always been a much more, there's still quite a bit of international stuff going on in New York, but New York is really strong because it's really the financial heart of the U.S. But London has always been more of a international banking center, and so what they did, this is a rate that goes back, I don't know, maybe 100 years, 150 years, and it's set by a very kind of archaic system where all the banks call in twice a day and they say, what rate do we think we could borrow from another bank? But it's not based on an actual market transaction. It's not like Bank A loan money to Bank B for 1 day or 3 days or 30 days, and that's the rate that they agreed and an actual transaction took place. It's mostly just people calling in and say, that's our cost, that's what we think we could borrow from other banks today. And so that led for apparently years a lot of manipulation, because what happened is an entire market developed around that rate in terms of when you have an interest contract that's a floating rate. So instead of having, say, a bond that pays a fixed 7%, you want a measure, say, a bond that pays inflation plus, say, 5%. But how do you measure that, what rate you're going to use as that peg for your floating rate? And since this is one of the most commonly known and oldest interest rate in the market, it was used, and we're talking trillions. I don't even know what's after trillions, quadrillions or something like that. Or maybe 10 trillion or $50 trillion worth of interest contracts were linked to that rate. And so you had a whole derivatives market. You had traders that would make these very precise bets and then leverage them up. And so if the rate came in, say, at 264 instead of 267, then somebody made like 100,000, 200,000, $1 million that day. And so there was a lot of shenanigans in trying to, just from 1 or 2 or 3 banks, because it's an average, I think, of like 15 or 20 banks. But if 2 or 3 or 4 banks at the same time put in a number that was way too low on purpose or way too high on purpose, it would move that rate, and then the traders would make money on that. Obviously, that's going to be one hell of a mess. Because think of, say, somebody in the U.S. that borrow, like we're talking like maybe a bond, or maybe a company borrowed money from a bank to build a plant or something, and then they find out that because of these shenanigans they had to pay an extra $200,000, $500,000 in interest over the life of their loan. They're going to be angry. They're going to want to take somebody to court. So this is a mess that I guarantee you is not, we have not heard the end of it yet. Now, next, swaps. Those are derivatives contract. By the way, the reason why something is called a derivative contract is because it derives its value from something else. It doesn't have a value in by itself, like gold has a certain price. The stock of IBM has a certain price. A derivative doesn't have a value. All it is it says it's based on something else. So say you could have something that trades that says what is going to be the price of gold 3 months from now, or what is it going to be. There's all kinds of these things like options on stocks. You're going to talk about that in other finance course later. Swaps are a specialized type of derivative, and there's two contexts that they apply. They apply an interest rate. Obviously, an interest rate, that's not this chapter, but it's put there to give you the context. If I have, there's two types of interest contracts or loans, either a fixed rate or a floating rate. If I have one, but I really want the other, and then I can find another person in the market that wants the opposite, like I'm person A, I have a fixed interest loan, but I really want a floating interest loan, say an example of a mortgage, and there's person B that has a floating rate loan, but they really want a fix. So what you do is you swap the two contracts, except that maybe one has a different size loan than the other. So banks are into the market where they sell these swaps, and what these derivative contracts do is they convert a floating rate loan into a fixed rate loan and vice versa. In the currency context, a swap is, let's go back to my very simple example. You have company A that operates in the US. You have company B that operates in Germany. Now, say these are fairly mature, established companies. They make I don't know. They make, say, car tires. So they have a pretty good idea. Each year they sell the same amount of car tires. One company, say, sells car tires. The other one sells diapers. So these are not businesses that change quite a bit from year to year. Especially if you're talking about very old, mature companies. So if you're the U.S. company, that every month or every quarter or every year, you're going to have to convert a certain amount of money from euro to U.S. Vice versa, if you're the European company, you know that, again, every quarter or every year or whatever, you're going to need to convert a certain amount of your U.S. dollar foreign income back to your home currency in euros. What a swap derivative contract says is that at a certain point in the future, we're going to exchange a fixed amount. So, company A is going to give company B some euros, and company B is going to give company A some US dollars. That's a swap derivative contract in the case of a currency.
And they have a fixed value for those?
Yeah, that's a way to basically you can lock in what you're going to get into the future. So that's a way for companies to reduce. See, the double-edged sword of currencies is, all of a sudden I made 20% more this year, but the other side of that is all of a sudden I made 20% less. So a lot of times companies want to lock in, and so they'll agree at 6 months from now, or maybe every month for the next year, we're going to trade that certain amount at that rate that we already agreed. That's what a swap derivative contract is. Now it says global capital market. The foreign exchange market is much, much larger than the stock market, the bond market, everything else put together. Because think of it, it's not just people buying ownership interest in companies or financial instruments. It's the global, if you want, the circulation system of the global economy. Every time something gets traded from one place to the next, and somebody gets a payment from one place to the other, the money has to go back and forth. So, if you think in terms of what is the size of the exchange rate market, it's the size of all the goods that are traded from one country plus all the oil that's sold in the world plus. And on top of that, there's banks that play in it for speculation, companies that play in it for hedging. It's a giant, giant market. Exchange. Obviously, the U.S. has quite developed capital market. Well, not so much less to say. Now, I'm sure that I'm not introducing to you what an exchange rate is. I'm sure you've heard of that before. When you've gone to another country, or you see them on financial news all the time. And it's what is the amount that you would get into another currency for a certain amount of the currency that you start with. Now, this is how it used to look. This is how people used to get their quotes. But let me show you how it's really done nowadays. Okay, so these are live quotes. You're looking at quotes between the euro and the US dollar, the US dollar and the Japanese yen, the British pound and the US dollar. Now, this is the quote that we really care about. The US, in terms of the Canadian dollar, went down quite a bit. I think it was over parity yesterday, and
That's 99 cents point something.
yeah. So yeah, because when I looked at it last night to get my thing prepared, it was well above parity. So you can see that. So parity is at 1. So when you're above that line, the Canadian dollar is worth more because you get more than, you get say $1 US and 2 cents for every Canadian dollar. When you're below that, not quite that line here, but that one here, so you can see that the Canadian dollar was above parity, and it had a pretty bad day. I'm not sure exactly what happened. Maybe the oil prices changed quite a bit, because
there was the release of the consumption today, and households in USA are spending more, so consumption going up, eventually going up.
Yeah, that's quite a move for one day.
Do you notice whenever the stock market goes down, though, the US dollar goes up? That seems to always...
The biggest relationship is between oil and US dollar, because oil is traded worldwide in US dollars. So if you look at what this here tells you is if you had Canadian dollars and you want to buy, you're selling US. Yeah, so yeah, you have Canadian dollars and you want to buy US dollars, so you're selling that pair, you would get 99.94 US cents for 1 Canadian dollars. But this is if you were going the other way. You can see how efficient and how liquid foreign exchange markets are. Look at the bid-ask spread. You're talking about, here you're talking about what? 1 basis point. And if you look at the Euro-US, you're talking about half a basis point of spread between the bid and the ask. Those are extremely liquid market. That's a way to look at how liquid a market is. It's by looking at what is the difference between the bid, what somebody is willing to sell it to you at, is willing to buy at, and the ask, what somebody is willing to sell it to you at. The further those are apart, the more we say that you have an illiquid market. But if you look at most of these markets are extremely tight. You're talking about the British pound to the US dollar, 1 basis point of spread. The US to the Japanese, half. I mean, these are essentially perfectly efficient markets. So this is how people used to look at exchange rate, more or less. Obviously, people that worked in banks had these computer terminals, but nowadays you can get, everybody can get something on their computer that gives the rate, second to second. So it's going back here. Consider that quote from the previous thing. Canadian dollar 1129 is how many Canadian dollars it takes to buy $1 US. The opposite is if you had how many US dollars you need to buy 1 Canadian dollar. So it's one divided by the other. This is in theory, but in reality you have that bid-ask spread from actual trading. I'll show you in a second a way that's easier to understand this than the way it's presented in the textbook, but here's the challenge. Most currencies, now it's a little bit too tight, the text is a little bit too small, but you'll see that most currencies are US, are given in terms of what the other currency is. But there's a couple of exceptions. The euro, the pound, and the Australian dollars. Those are quoted the opposite. And historically what they would show is when it was a rate quoted in terms of US dollar, you would just have it regular. But when it was a rate that was the US dollar in terms of that, the foreign currency in terms of the US dollar, then the people would put a little asterisk next to it. It gets confusing because you're thinking, am I multiplying by that number? Am I dividing by that number? Am I multiplying by one, which one do I take? Do I flip it upside down? Am I multiplying? Am I dividing? I'll show you a much easier way to make sure that you get it right. Because it's so easy to flip a fraction and make a mistake. So if you look at that, you have the first example up there. You have 10,000 US dollars. Based on the rate on that previous figure, how many Swiss francs can you buy? So you have 1.2214 francs per US dollar. So here's how you would write it out to make sure you get it right. And it just goes back to, I've been showing you this trick, the whole idea of using units and then canceling them out to make sure that you get to what you're looking for. So in this case, I have 10,000 US dollars. I'm going to convert them at the rate of 1.2214 CHF for 1 US dollar. Now, these three-letter codes are a lot easier than having to find, this thing on your keyboard. Because if you bought your keyboard in the States, I guarantee you don't have that on your keyboard. Or you don't have, I think the Japanese, it looks something like this. Then you have the British pound, don't even remember what it looks like. So these currency codes have 3 letters. They're commonly used, and they're based on another standard. So every country in the world has what's called an ISO country code. It's 2 letters. So, US, Canada, CA, and so on. Switzerland, it's a little bit off. Usually it's pretty obvious what the country is. Switzerland is CH. You guys should know that. Why is it CH? Oh, they live right next to it. It's Confederation Helvetica. So, the word of the font Helvetica comes from, it's an old word that means, whatever, the area of Switzerland is. So Confederation Helvetica franc, US dollar. Then we're going to have other ones like GBP, Great British Pound, and so on. You have JPY, Japan Yen. So these codes are a lot more easy to use than these funny, curly letters that you might not be able to find on your keyboard. Because when you go to type, say something like this, You know, I'm typing, you know, dollar, but then I got that pound sign, and then maybe I got Japanese yen and so on. It's a lot easier if you just use. See, I didn't even have the euro symbol back then. It's a lot easier if instead of those curly characters, you use the ISO 3-letter code for the currency, and then you treat that as a unit of your measurement. So you have 10,000 US dollars. You're going to multiply it by a factor, 1.2214 francs per US. Now these two things are going to cancel out, and so you know that you have an answer in francs. See, here's the mistake that is so easy to make with currencies that students make over and over again, and it's not because you don't know what's going on or you're stupid. It's just such an easy mistake to make. You know, you multiply, you divide by 1.2214 instead of multiplying, or you multiply, but you don't know if am I taking 1.2214 or the inverse, or it's so confusing. But if you write it this way, where you know what amount you start with and what it's in, and then you have a conversion factor, and you cancel things out so that you get what you're expecting. See, if I wrote this the other way, and I ended up with an answer, say if my fraction was, you know, US dollar, and then I multiplied it by something, you know, US dollar in francs, what would happen? I would get an answer in US dollar squared divided by francs. That makes no sense. So by using this way, as opposed to, you know, when I look at some of these, I have Indian rupees, I'm dividing by this. Am I getting a dollar? Am I, you know, multiplying by a fraction one way or the other? It's a lot easier to use this system. And now, this is, you know, nothing compared to the complexity of some of the further problems we're going to get into in this chapter. It's a lot easier when you do it this way, because you know that I'm starting with US dollars. I got an answer in Swiss francs, and that's what I was expecting. And so it's a way to make sure that you didn't make a stupid little mistake and flip a fraction somewhere. Because when we're going to do, you know, more complicated situations where you're doing 2 or 3 different currency conversions, and you just flip one fraction and your whole thing is blown. You know, if you go through the whole chain and your currencies balance out properly, and you get to the end and you got the right currency, you know you got it right. It's a nice way to do some quality control on your answers. So that next one here, it's flipped around. But, you know, the exchange rate is 49.88 rupees per dollar. I got 1,000 rupees. So am I multiplying, am I dividing? Here's how you write it out. I start with 1,000 Indian. IN's the 2-letter code for India, and R for rupee. And now, if I have a rate that says I have 45.88 rupees per US dollar, just by looking at the way that the fraction is set up, I know if I have to multiply or divide. Because if I have 45.88, and if I try to multiply, I realize that, you know, my things are not canceling out the way that I expect them to be. So that's a very nice way to make sure you get things right. So in this case, you get your 2180 US dollar. Well, here's an example of, not really that much more complicated, but now this is a situation that would happen in your personal life, but businesses are faced with similar situations, right? They have, they need to buy something in one currency, they need to sell it in a different currency, how much they need to budget, this and that. They have to figure stuff out. In this case, that's just kind of a warm-up example. It's just a scenario that people like to dream about, to go hang out in Australia for a little bit. So your budget that's an amount in Australian dollars, so AUD Australia dollar. A lot of codes have D at the end because the expression dollar is used in quite a few places. The US dollar, the Canadian dollar, the Australian dollar, and so on. So in this case, your budget is 150 AUDs per night. You have 5 nights. And your flight is 2,000 AUDs. And that does illustrate really the challenge for companies when they operate in more than one country. When you were doing a balance sheet, an income statement, a statement of cash flow, you just put your numbers through. But now, if you have a company with different operations in different places, when you have an amount, you have to keep track of, is that amount in what currency? So typically, accounting systems that do multiple currencies are a lot more expensive than single currency accounting systems because there is quite a bit more complexity there. So you know what it's going to cost you in Australian dollars. So how much is that going to be in Canadian dollars? So you're faced with this, Canadian dollar equivalent currency per Canadian dollar. How do I read that? Well, currency per Canadian dollar, that means that would give you 1106 Australian dollars per Canadian dollar. Or the opposite, Canadian dollar equivalent, tells you how many Canadian dollars this other currency is. An easier way to write this is like you've seen before. So now you can get to it 2 different ways. You could either say 0.9004 CAD per AUD, and the answer would be 2476 Canadian dollars. Or you could have done either way, you end up at the same place. Well, you can see that faced with this problem, there's 2 right ways to do it and 2 wrong ways to do it. So by using this little trick, it makes, yeah.
Why the first 2 examples of one Canadian dollar up and the first one under the exchange rate?
Sorry? Can you repeat your question?
Yeah, why you put here you put 2750 times 1 over 1.1106, right?
Yeah.
So why we don't put it like as 1.1106 over 1?
Because then you would not get the answer that you're looking for. If you multiplied 2750 by times 1.1106, you would end up with an answer in Australian dollars squares per Canadian dollar. That makes no sense. Okay? Okay, here's where this trick becomes useful. When you're looking at 3-way conversions and 3-way cross rates. So in this case, we want an answer in Japanese yen per Canadian dollar. So what's the way to write? We want to get to JPY per CAD. What are the different rates that we're given? We're given 115 CAD per USD. We know that 115 JPYs per USD and 105 JPY per CAD. Now, if you look at what rate would we get if we go from so this 115 CAD per USD is when you're going this way. This 115 Japanese yen per USD is when you're going this way. And this 105 Japanese yen per CAD is when you're going this way. But if you look at this picture, there's two ways to get to a Japanese yen starting from a Canadian dollar. Obviously, if it's 1.15 Canadian dollars per US dollar, that's the way that you're going this way. But that means that to go the other way, it's 1 US dollar per 1.15 Canadian dollar. So that's the exchange rate to go this way. Now you can see two different paths. To get to a Japanese yen, you can either go from a Canadian dollar to the US dollar to the Japanese yen, which is what we call the cross rate, or you could go straight from the Canadian dollar to the Japanese yen. But they're different. If you look at, if you went this way, so this path, it would look like that. USD multiplied by So you went from, when you go this way, you end up with 100 Japanese yen per Canadian dollar. But when you go directly, you end up with 105 Japanese yen per Canadian dollar. What happens? What you can do, that difference is what's called an arbitrage opportunity. What is an arbitrage? You're going to see this, we're just introducing it into 505 here, but you're going to see that more into more advanced finance theory courses. There's this fairly central concept in the theory of finance called arbitrage-free pricing that a price should be based on something where there's no arbitrage. What's an example, a very basic example of an arbitrage? Historically, there was a family in Great Britain called the Rothschild, and you might have heard that name from being a bank. And the way that that family got extremely rich is, put it this way, if you knew what the price of gold was, say, in one place and what the price of gold was in the other place, and you could buy in the two places at the same time, what you would do is just buy it where it's cheaper and at the exact same time sell it where it's more expensive and make free money. People love to make free money, so they do this all day long. And then, the next day and so on until the prices get back into equilibrium. The Rothschild family, what they more or less invented the concept of arbitrage. What they would do is they would have couriers, I think on horseback, go between, I think there were three brothers. They had one, I think, in France, one in Italy, and maybe one in England. I guess, on a boat too. What would happen is when the price of gold would be different in different cities, they would buy it in one city, sell it in the other city, and they would keep an inventory in each city, and they made a ton of money like that. They basically built one of the greatest fortunes in the history of Europe. That's the concept of an arbitrage. If you're able to, and that's the key point, at the exact same time, take two transactions that should be equal to the same amount, but they're not, what you do, you just do this all, you just keep doing that. In this case, you go from the Canadian dollars to the Japanese yen, and then you sell it the other way. Wait a second, no, you go from the Canadian dollar to the Japanese yen, you get 105 Japanese yen, but then you can trade them back at 100. So you keep doing that. Every time you do this, you make $5. So what happens? Anytime somebody finds a relationship like that, and it happens, but nowadays when an arbitrage like this comes up, you have banks that have $1 million worth of computers that look all over the world, all the different markets. If at any point they can see these imbalances where for some reason the price is going up in one place and going down in the other, what they do is at the same instant moment, they sell in one place, buy in the other, and book a riskless profit. What that implies for the theory in finance is that any price where you can come up with an arbitrage relationship like that, the price should be equal in the two places. So as in, the price of gold should be the same in New York that it is in London. That's a very simple version of arbitrage. In the case of currencies, the cross rate should be equal to the direct rate. Otherwise, somebody can do this triangle arbitrage thing and make money all day long. What happens when they do? They're going to be putting buying pressure under, if for example, going back to the basic case, the price of gold is different in two cities. What happens if the price of gold is higher in one city and lower in the other? So what you're doing is you're buying out of city B and you're selling it into city A. What does that do? When there's more buying pressure in one place than there's selling pressure, the price goes up. And vice versa, when there's selling pressure in one place, there's more sellers than there are buyers, then the price goes down. So through somebody arbitraging, you just keep doing it over and over, because I guarantee you everybody loves free money. So they just keep doing that all day long, buying gold in one place and selling the other. And then, now the price is only $4 apart. So I'm just going to keep doing it. Keep doing it and keep doing it and keep doing it. And what happens is it brings the two price into equilibrium. If you do this often enough, the buying in where that price is too low will go up, and the selling where the price is too high will go down to the point that the two prices are going to become equal and in equilibrium. That's the concept in a triangle arbitrage. If you're able to trade from one currency to another and to a third and get a different amount than going direct from one to the other, what happens is, and nowadays I guarantee you that bank computers spot these things in like half a millisecond, boom, 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 and these things, that's why these imbalances never last for very long, because everybody loves to make free money, and so they do this. They basically go where, in that case, you get more going directly. So you go directly and then you trade back. You enter the trades, the three trades exactly at the same time, and boom, you just keep doing that. What does that do? Well, in that case, the triangle arbitrage, I got another example in a sec, but in this case here, the triangle arbitrage is going this way. So somebody starts with a Canadian dollar, gets Japanese yen, transfers it back to US dollar and back to Canadian dollar, and now they got $5 more. So what do? You're just going to keep going around that circle as long as it works. And what does that do? Well, on this side, you're going to push down the rate because you're selling the Canadian dollar, buying the other one. And on the back side, you're going to have the opposite pressure. So what does that do? Because of this triangle arbitrage argument, it means that the cross rate from currency A to B to C should be equal to the direct rate between A and B. Otherwise, somebody's just going to pull this trick until the two come back into balance. That's the idea of a triangle arbitrage in the context of currencies, and why the cross rate should be the same as the direct rate. So let's do an example. And this is where, when you're translating from one currency to the other, like that first simple example I did, using my trick with the currency codes, it's not that much of a gain. But once you start dealing with three currencies and three different transactions and so on, it's a lot easier to understand it and write it out in terms of the currency code. So let me show you an example. Okay, so I'm going to start with a US dollar. I'm going to go into a British pound, GBP, and the other currency is the euro. So what are the rates that I have quoted there? I get $1 US per, so if I want to go, if you start with a US dollar by exchange, look at this way, this way, this way. When you do a triangle arbitrage type of problem, if you go around the triangle, clockwise, and you end up with less money than you started with, then all you got to do is do it the other way, and then you'll end up with more money than you started with. When the cross rate's in equilibrium with the direct rate is when the amount of money you start at, you end up with the exact same amount of money that you started with. So in this case, I start with $1 US. I convert it into British pounds. So this is the first part. At 0.6928 British pounds for $1 US. Then I convert it into euros at the rate of €1 per there's a mistake in my thing here. $1.65. You got
No.
what's the other word? Yeah, there's a mistake in the way that the TA typed the notes. I'll have to fix that later. And so this is the second step. And then the third step is converting. Now you have, so you started with US dollars, you converted them into British pounds, then you convert them into euros, and then you convert that back into US dollars. So you got $1 US per so you can see that US dollar cancels with US dollar, British pounds cancel with British pounds, and euros cancels with euros, and I'm left with an answer in so if I started with $1 US, I end up with an extra cent and a half every time I do this. So what am I going to do? Just going to put this computer on, just loop, just keep doing this. Because for, say if I put, if I put $1,000, I make $10, $10.50. So what do? I keep doing it every second as long as that works. What does that do? That balances the rates back into what they should be. That's why markets are stayed in equilibrium, because anytime things go out of balance between one set of rates and the other, and now it used to be done, like the Rothschild days, it was done, on horseback and, people buying, guys buying gold on the street. But nowadays it's done inside computers, and it's done in milliseconds or even less than that. That's the concept of a triangle arbitrage. If you did this, you can try it, and you go the other way, you're going to find out that you're going to end up with less US dollars than you started with. So therefore, in that case, if you do a triangle arbitrage clockwise, you end up with less than you started with. Do it counterclockwise, and you end up with the money that you were looking for. Okay, it's 7:58. This is a good time to take a break. So okay, it's 8:10. Let's continue. So now we're going to talk about two different types of currency trades: spot trades and forward trades. Spot trade, it's really, the words say it quite easily. A spot trade is something you do today, like not even today, like this second. A spot price means executing the transaction, on the spot, as in the present moment. A forward trade is where you execute a transaction, but the actual exchange of money happens into the future. So it's an agreement. A forward trade and a swap contract are essentially the same. It's just from the point of view, the first is one-sided. A forward trade is one-sided, whereas a swap there's two parties with the bank in the middle. Whereas a forward trade there's just the bank and one party. So if you look at the way that exchange rates are quoted, so I can actually make that bigger. So if you look at easier for me to point at there. This is what, if you look at this chart here, the previous chart, the other one is all the spot rates for all the different currencies. This is the forward exchange rates for, you know, the major ones. Well, obviously this is a Canadian paper. You know, normally Canadian dollar is just peanuts on the global markets, but this was probably, you know, the Globe and Mail or something like that, or Financial Post. So you have the Canadian dollar, the euro, the Japanese yen, and the UK pound. By the way, the US dollar, the euro, the yen, and UK pound, those are the kind of big four currencies in the world. Right? They account for most of the world trade. After you drop off from the US, the euro, the yen, and the pound, I mean, then it's just a bunch of little countries. Right? In this case, you know, Canada's being an example, but in most, those are what are called the major currencies, those four. So then here you have three major currencies and the domestic currency, and instead of being just quoted just one number, it's too hard for me to scroll up, but if I looked in the table the big table that I had before, you would see that the exchange rate between the Canadian dollar and the US dollar was 1.129, between the euro and the US was 1.2792, and so on. This is what, you know, I walk into a bank, I call a bank, and, you know, this minute, this second, this is, I can get obviously that was a while ago, I can get 1.1129 US dollars per Canadian dollar. So that's the spot rate. The forward rates are, if I call up a bank and I say, I want to lock in today what I'm going to be able to exchange US dollar 1 month from now, they're going to say, okay, we're going to enter into a contract with you today. So, you know, the transaction is legal. You know, the legal contract happens in the present, but the actual exchange of money happens at that forward date. So 1 month from now, we will guarantee you today that you walk into our bank, or, you know, you call us up and you give us $1 US, and we will give you. Sorry, it's the other way. You give us $1 US, and we will give you 1.1125 Canadian dollar. Yeah. Then if you go into further and further into the forward curve, so you look at 3 months, 6 months, 1 year, 2 years, you can see that some of them are going up. Right? The Canadian dollars per US is good. It's 1.1129, then 1125, 117, 1094, 1040, and 0947. So we say that the Canadian dollar is at a forward discount to the US dollar. So the further you go into the future, the less the Canadian dollar is worth in terms of US dollar.
Is it the opposite though?
Yeah, I always flip it. You know, it's late for me too. So sometimes, sorry, I make a mistake. If you look at the UK pound, is it, you know, no, the UK pound's going down. All right, the euro is at a forward premium to the US dollar. That means that the further you go into the future, the more our euro is going to be worth. Vice versa, the further you go into the future, the less a Canadian dollar is going to be worth. Well, the less a US dollar is going to be worth in terms of Canadian dollar. So if the forward rate is higher than the spot rate, the foreign currency is selling at a premium. Vice versa, if the forward rate is lower than the spot rate, the foreign currency is selling at a discount. Where does that come from? To understand where that comes from, there's a whole, see, this is one of the most technically complicated chapters because there's a lot of kind of macroeconomics thrown in at the same time. To understand where these forward premiums and forward discounts come from, we got to look at a couple of microeconomic concepts. or sorry, macro. Absolute purchasing power parity. The price of something should be the same in two countries. It's in reality, it's not. The reason why it's called absolute is, this perfect world where everything, transaction costs are zero, meaning that it's costing you nothing to ship something from one place to the other. Obviously, in the real world, for physical goods, it's not true. The shipping costs have gone down, but they're not zero. Can somebody give me a good example where you have purchasing power parity where you would have no transaction cost? Or the transaction costs are so small that they don't exist. Or they're so small you don't even count them. Think of the whole outsourcing to India business. Right? It used to be, if you make like a car in China and you want to have it in New York City, you got to put it on a boat. It takes time and it costs money. But if you, yeah, that's what I'm saying. Any kind of a lot of the services, IT, call center stuff that's been outsourced to India, because people in India are just as educated as people in North America nowadays, but they're willing to work for less. But their labor, the product of their work can be transferred over phone lines for half a cent and a second or something like that. So that's an example where transaction costs are zero or almost zero, that they don't count. No barriers to trade, right? If you have, for example, in Canada and the US, we've had that for a long time. Right now, the best example is cheese. Cheese costs 4 times more in Canada than it does in the US for the same amount of weight. Why is that? Because in Canada we got these, this protectionist system where, you got the dairy boards and all this, and at the same time we have laws that, there's actually, I saw that in the news a couple of weeks ago, that I think it was maybe in Saskatchewan or in Alberta or Manitoba, one of these places, where there's people that went to jail for smuggling a couple tons of cheese or something like that. So it's not just drugs that people get in trouble for smuggling. It's goods that are under protectionist rules. A lot of times these protectionist rules are meant to protect an industry within a country, usually because, go into political risk. You have if you could freely trade cheese between Canada and the US, and it costs almost nothing to transport it between one place to the other, what would happen to the people in Canada that sold it for a lot more expensive than people in the US? Well, the customers in Canada would say, I'm not paying 2-3 times more for your cheese. I'm going to go buy it in the US. So that over time, the Canadian producers would have to lower their price or nobody would buy their cheese. So whenever you have transaction costs are zero or very small so that they don't matter that much, and the most important one is there are no barriers to trade. Right? There's not an actual law that says you're not allowed to take, there used to be stuff like that, in Russia. You're not allowed to import jeans or something like that. In Canada, we have this thing, you're not allowed to bring dairy products across the border. They say, it's the, protect from animal disease and not bring, infection to farms and so on. But the real reason for those laws is to make sure that Canadian farmers are able to get a much better price than if they had to compete on an equal basis with dairy producers in the US. So the second one is the most important to understanding this concept of purchasing power parity. Then the last one is there's no difference between the commodity between the two locations. The cheese comes out of a cow on either side of the border. If I showed you a cheese that came out of a cow from Canada and came out of a cow from the US and it was made the same way, you can tell the difference, right? The actual physical good has the same specification. Let me just skip. It says absolute purchasing parity rarely holds in practice for many goods because there's sometimes some of these things, right? You have to ship one thing from to the other place, and so that's why pricing differences persist. or there's actual laws where it restricts that trade from going back and forth. The last one, the no difference in the commodity between locations. The Economist, which is a very famous magazine, I recommend it. It's always pretty enjoyable, one of the best financial publications to read. I'm just going to skip forward. They came up with this now the sorry for the picture. You can look at it in you can look at it on your later. What they came up with is what they call the Big Mac Index, because a Big Mac is the same whether you buy it in New York City, at an airport in the UK, or at a restaurant in South Africa. A Big Mac is the same in each place. So you have that first thing where the specification of the good is the same in each place. So you can look at what does it cost to buy a Big Mac in the United States. Well, that was based on July 2001. So it costs $4.07 in the US. Obviously, that's probably an average. I'm going to skip Argentina for a second because I was reading the background on this. It turns out that Argentina is controlling their prices. But say if you look at Britain, or let's say we look at Canada, buying a Big Mac, the average in Canada is $4.73. So what that means is the equivalent price in US dollars would be $5. That implies that the exchange rate between the two is 1.16. But the actual exchange rate is 0.95. What that gives you, this purchasing power parity thing, gives you a way to figure out what exchange rate should be based on if prices in the different countries would be the same. Now, they use it's kind of a cute thing they did for fun, but it does illustrate a concept that when you have a good that's the same in each place, but the only difference between cars in the US and cars in Canada is the speed indicators are in miles instead of kilometers. So, people don't really want to buy American cars. So that's one of the reasons why, the price of the cars don't quite balance out the way they should. So you can take whatever the exchange rate, but you can look at the same good in the different countries, and you can come up with an implied PPP, purchasing power parity, right? It should be worth the same after adjusting for exchange rate in the two places. Oh, that's what I want to do. So let's look at a simpler example here. Suppose absolute purchasing power parity holds. The exchange rate quoted for Indian rupees is 0.02312. If a car costs $35,000 in Canada, how much should that same car cost in India? So this is really just a conversion problem. You got 35,000 Canadian dollars. You got 1 rupee per 2.3 Canadian cents. So a car that's the same in the two places, if it costs 35,000 in Canada, it should cost 1.5 million rupees in India. This is how you go from one currency to the other. Now, this is the trick here that comes behind, that is behind that Big Mac index. If you have the price of two goods, of the same good in two different places, then you can come up with what is the implied exchange rate that you get from that. So if an apple costs $4.08 in Canada, and that exact same apple costs $3.80 in the US, then that gives you an implied exchange rate of 1.074 Canadian dollars per US dollar. That's the implied purchasing parity exchange rate. Relative purchasing power parity. The absolute purchasing power parity is hard to look at because there's not a lot of goods. They're the exact same in two countries, and you can't ship a Big Mac from Australia to Germany and be able to look at it's not quite, there's transaction costs there, there's shipping costs. So absolute purchasing power parity is a little too strong. So next, economists started looking at this idea of relative purchasing power parity, where the difference between the two exchange rate is based on the difference into the future of the forward rates is based on whatever the spot rate is, plus what the difference in inflation rates between the two places is going to be over time. So when you have a currency that's at a forward premium, it means that over time, the inflation in that country is going to be less. So it's going to, the same amount of that currency is going to be able to buy more than the other one into the future. That's where that forward rate comes from the difference in inflation rate between the two places over time. So suppose the Japanese spot rate is 130. Japanese inflation is expected to be 2, but the Canadian inflation is expected to be 6. Since inflation is higher in Canada, it means that the dollar will depreciate relative to the yen. In other words, a Canadian dollar 3 years from now is going to be able to buy less than a yen 3 years from now because it's depreciating. It's got higher inflation over time. Therefore, if you're getting 130 yen per Canadian dollar today, that 130 is the spot rate, S sub 0. Because of the spread between the inflation of 2 and 6, that means that 3 years from now, you expect to be able to get 115 yen and 2 yen cents. I'm not sure what they call them. Let's just say 115 yen per Canadian dollar. So you can see that the Canadian dollar is at a forward discount to the Japanese yen. The Japanese yen is at a forward premium to the Canadian dollar. Let's look at an example. So what is going to be the E something is a statistical thing where it means what is the expected value of that variable? Because you don't know, you know what S0 is. Right? That's what you could call up a bank today and change your money at. But S1, so S0, that's a known variable. S1, that's an unknown variable. You're not sure what the spot rate a year from now is going to be. So that's why we use this thing E. That means the expected value. That's a statistical thing, statistical term. So what ES1 means is what do we expect the spot rate a year from now to be? In this case, based on the, it's the spot rate today times 1 plus the spread between the British inflation and the Canadian inflation. And it's to the first power because the equation is EST is 1 plus the spread between the two inflation to the t to the power t. So when you're looking just 1 year into the future, it doesn't really matter because that number is just 1. Therefore, the spot rate today is 5810. And because the inflation in Britain is higher than the inflation in Canada, a year from now, $1 Canadian will get you more British pounds than you would have gotten today. Right? So in this case, we say that the British pound is at a forward discount to the Canadian dollar, and the Canadian dollar is at a forward premium to the British pound. And we have a similar thing that to what we looked at before. You can look at it from two different ways. Is if you have the forward rate between two currencies, you can come up with what is the implied inflation between those two currencies from what the market is telling you. So in this case, now it just says the inflation in the foreign country, doesn't say what that foreign country is. And if my inflation was 57%, I'd be ashamed enough that I wouldn't want people to know what my name is. So, if I have inflation in the foreign country is 57% and inflation in Canada is 4%, then that means that the exchange rate will change by 53% over the next year. Now comes the toughest part of this chapter. We talked before about, or I talked, yeah.
Do you have an example where it's the exchange rate you're trying to find out is like over the span of more than 1 year? Like, I'm just trying to figure out, like in the formula, when you do, like, for instance, for your last example, 0.08 minus 0.05.
Here's an example right there where you're looking at it 3 years.
Right. Okay.
So the formula has this power t up here.
Yeah, that's what I wanted to know actually. Is where, how to, like, okay, I see it's outside of the brackets. That's all I wanted to know.
Yeah.
Okay, so I have to figure that out first. And then,
So when you want to know, when you're looking at it just 1 year forward, there's no power. When you're looking at it at more than 1 year forward, it's 1 plus the spread between the two rates, between the two inflations. Okay, covered interest arbitrage. We had the triangle arbitrage, and if the example the Rothschild and the gold was the basic example of an arbitrage, and the triangle arbitrage was, say, the intermediate example of an arbitrage. Covered interest arbitrage is what I would call the advanced example of an arbitrage, and it goes this way. You come up with a relationship between spot rates, forward rates, and what nominal rates. Nominal rates meaning the interest rates that include the inflation, right? Not the real rates, but the the rate that includes the inflation plus the real rate, which is called nominal. So let's look at this example here. We have a couple of different rates that we're looking at. The spot rate today is we can get 2 British pounds per Canadian dollar. The nominal rate in Canadian dollars is 10%. The forward rate, so the 1 year forward rate is 1.8 British pounds per Canadian dollar. And RB, it should say RGBP, because it says rate Britain. But the nominal interest rate in Britain is 5%. So what is the arbitrage opportunity? Let's look at it this way. You start with 100, well, you borrow it, you get 100 Canadian dollars. You convert it at the rate of 2 British pounds per Canadian dollar. So you have today 200 British pounds. You invest, you buy a bond that pays 5%. So 1 year from now, you will have 200 times 1.05. So you will have 210 British pounds. Then you know that even though this thing, the actual money will exchange hand 1 year from now, you know that you're locking in this thing in today, in the present. The forward rate means that today you can enter into a contract that says, I'll be 1 year from now able to exchange. Now, if it's going at 1.8 British pound per Canadian dollar, it means that we will get 1 Canadian dollar for 1.8 British pounds. Meaning that when you transfer 210 British pounds into Canadian dollars at that forward rate, and remember, that's the key point of this argument here, is that happens all at the same time. Right? You look at this and you lock in the 3 trades instantaneously. You end up with 116.67 Canadian dollars. So you borrowed that, you started by borrowing that 100 Canadian dollars, you borrowed it at 10%. So you have to pay back $110. But by doing this, you locked in, you guarantee, there's absolutely no risk that for sure you're going to get $6.67 a year from now. So after paying back $110 that you borrow, which is the 100 that you borrowed plus the interest, you're left with 6.67 Canadian dollars of free money. Again, same argument that has to do with arbitrage. People love to make money for risk-free, so they're just going to they're going to do this. They're going to enter into this trade until the exchange rates balance out. What is that going to do? Well, if you buy British pounds in terms of Canadian dollars, you're going to strengthen the the British pounds, and you're going to weaken the Canadian dollar. So what's going to happen is, as these arbitrageurs do this between the spot rate the GBP and the forward rate, as people do this, because I guarantee you people love to make risk-free money, and people will just keep doing this over and over again, and it will put pressure on the on the spot rate, the British interest rate, and the current forward rate, and these will get back into equilibrium so that you will end up eventually with 110. So maybe that rate's going to go to 1.85. That thing's going to go down, say, to 4.9, and then the rates are going to balance out. The interest rate, the spot rate, and the forward rate are going to balance out where you don't have this covered interest arbitrage. Therefore, there's a forward rate that would prevent the covered interest rate arbitrage. And that rate is called, it's a relationship between F1 S0 and the rate between the two countries. There's an exact and an approximate relationship. It's just because when you have 1 plus, say 1 plus a number divided by 1 plus another number, that's fairly closely equal to 1 plus the difference between those two numbers. It's just an approximation that's fairly close, as long as you're within, not too far from these numbers. So because this should not exist, because if it does, people will just, buy in the borrow in one currency, buy in the other, borrow in one currency, transfer it to the second currency, invest it into this forward carry trade, and then convert it back at the forward rate, which they lock in today. Because of this, you can come up with, like I told you, you're going to see that more into third year and fourth year, what are called arbitrage-free pricing. You end up with that equation, that the ratio between the forward rate and the spot rate should be equal to the ratio of the two interest rate between the two countries. And whenever those four numbers are not in balance, people do this until those numbers get back into balance. So let's look at an example here. So that's why you can look at forward rates and imply what the inflation rates are, or if you had market traded inflation rates, you can imply what the forward rate should be from that. So in this case, F1, and I'm going to give you those two formulas in a quiz or final. The first version is what's called the exact. The second one's called the approximate. You just have to read the question and look for the keyword approximate in there. Is it there? Then I use the second version. If it's not, I use the first version. Since it says there, approximately what rate can you earn by investing in the Canadian risk-free security for 1 year? HKD, that's another dollar, the Hong Kong dollar. So that's the approximate interest rate parity between the two, between the forward rate, the spot rate, and, sorry, it's not F, should be R. So what does that mean? We want to know, we know F1, we know S0, and we know RHKD. We want to know what is RCAD. Therefore, I'll just rewrite that equation in terms of RCAD. That means that if the spot rate is, if the forward rate is 7.27 and the spot rate is 7.98 and the risk-free rate right now in Hong Kong is 5, that means that the risk-free rate in Canada should be 13.9. If it's not, then you just pull that covered interest arbitrage over and over again, and eventually the rates and the spot rate and the forward rate will get back into balance. Now, here's another example. Now, it doesn't say approximate anywhere. And you can try that question with the approximate equation, and you will end up at 4.25. But if you use the exact equation,
How many marks would you get if you use the wrong formula for the wrong version?
what?
Like if you use the one formula for the other version, how many marks would you get?
You would lose a third of your marks. Because roughly when part marks are allocated into a written question, it's 1/3 for the formula, 1/3 for putting the right numbers in the right places, and 1/3 for knowing how to use a calculator. So right now, I want to know what is RGBP. I want to know what is RGBP. I know RCAD and my spot rate and my forward rate. So I want to rewrite this. So 1 plus RGBP is going to be equal to so all you're doing here is taking this expression and multiplying it on that side, and then take the 1 and bring it to this side. So that's your F1, that's your S0. The nominal risk-free rate is 2.5% in Canada. So 1 plus, that's your 1.25. And then minus 1. That gives you 0.0430, which is 430. And so we'll stop here for tonight. And then I will start with unbiased forward rates next Tuesday.